Hi, I'm Karen Boyle from Back in Black Bookkeeping. I'm talking today with John Kirk from the Small Business Assistance Guide. And what we thought we might do today is just have a bit of a chat, a bit of a question and answer based on John's experience as his previous life as a ATO auditor, and just find out a little bit about, for the both of us, why bookkeeping and why record keeping are important for small business owners. So, firstly, John. So, John, if you are unlucky enough to have an ATO audit, what's something that what's probably the first thing that the ATO is going to look at when they come in?
Well, Karen, from an ATO perspective, what they're actually looking for is anything which is a little bit out of the ordinary. For instance, if they're looking at your BAS, for instance, and they notice that there's an amount, for instance, in expenses which is a lot higher than what it was in the last quarter, they'll be looking at things like that. They're looking for anything which is actually out of the ordinary. You might have purchased a vehicle, for instance. You might have paid cash for it. The ATO don't know that. All they see is that all of a sudden your expenses have jumped up. So they think we better check this out. Okay, so that's basically what happens. It will normally be a phone call first. They'll ask you whether you can substantiate any of it and what the and why. Can you explain why the amount is higher? And then, if necessary, they will send somebody out to see
to
you.
have a look,
Or they
to
might
see what's going on.
Or they might even just call for one document. Say, can you send in that purchase agreement? Okay.
Does that also sort of tie into benchmarking a bit, like with the different industries?
Yes.
So sort of if there's an anomaly with your figures, like if you're a cafe owner, for instance, and your figures are completely different to everyone else in the cafe industry.
Yes.
Is that another sort of trigger for the ATO to sort of start
Correct. Correct. If that is a situation, all of a sudden your expenses are much higher than what theirs are, that creates a little bit of a spike, you might say. The tax office will have a look at that, and you will need to substantiate what your expenses are at that particular time. It also, when you're talking benchmarking for a cafe, they also look at how much business that you've done in cash and how much you've done in credit. Okay, so that's something that you need to be aware of as well.
Oh, very good. Okay, so if you sort of move past that sort of initial stage, and then the ATO do decide to come in and do an audit, what are they going to be looking for with your bookkeeping sort of, or your record keeping basically? Okay.
They'll normally look for they'll have a look and make sure that you're keeping your records correctly. They don't want to see a shoebox. Okay, like they used to see. So what needs to happen is that when they come in and they ask to look at certain documents, they really like it if you've got those documents on hand. If you can say, yes, I can find that. And you also need to realise that if they do an audit, it's not going to be something that happened 3 months ago. In most cases, it could be a year, 2 years, even 3 years ago. So you need to keep records and make it easy for the taxman.
Because the regulations with the tax office is you need to keep your records for 5 years. Is that right? Yeah. So potentially, you could have to go back 5 years. So
if there's a capital gains issue, it's even longer than that.
Longer,
but everything else, 5 years. If you don't keep them for 5 years, and if I was an auditor like I was with the ATO, and I walked in and I said, look, I want to have a look back 4 years, and you said I haven't kept anything from 4 years ago, that's going to create a real problem for you.
We don't want that. Okay, moving on from there. What happens with people that don't have their records kept straight, whether by design or by accident, or maybe even sort of an answer for both?
There could be penalties involved. For instance, the tax office will look at what you've got. They'll look at whether it seems to be correct. They'll look at whether there might be invoices missing. For instance, you've issued the first 50 invoices and all of a sudden you're issuing invoice number 121, that sort of thing. They will look into all of those types of things, and if you don't have the records that they require for a certain period or a certain time, they will tell you to go back to your accountant if you're using an accountant and get them reconstructed. Now, if you can't get them reconstructed, the tax office will have a look at your figures for the previous couple of years and the years since, and they will make a decision as to what your figures might have been for that year.
So they'll deem what they think the figures will be. They'll make a decision and say,
correct,
based on the previous quarter, we're saying that this is what this quarter will be the estimate for. Okay.
That's right. Yeah.
So, if that happens, will you be fined? Will there be penalties, that kind of thing?
There definitely can be.
Yeah.
And you need to be aware of this. If you've been in business for a number of years, they expect you to know what to do.
Yeah.
Okay? Now, if you've been doing all your record keeping yourself, and they look at it and say, you should have known better, you could get penalised quite heavily. It can be as much as 75%, which basically means that you haven't been doing the right thing and you knew you weren't doing the right thing, or 50% or 25%. It comes down in stages depending on what the error is. The error may not have been a big one.
So say if it was like a $10,000 error, that's when they sort of charge you a penalty, 75% of that error, is that?
Yes, it can. It can be as high as that.
Okay.
Yes. In most cases, it's not. But 25 and 50% is very, very common. Most people don't. It's normally not 75%, simply because most people aren't identified as doing the wrong thing on purpose.
So there's the difference between fraudulent and.
Yes, definitely. It's normally carelessness, or an unfortunate mistake. If it's an unfortunate mistake and it's your first one, it's a good chance they'll let you off. But if you've been doing it consistently, they won't. So you're a repeat offender that you're going to get penalised for that. A lot of people ask me, Karen, how do you solve that problem? Well, my answer to that is, do not let it get that far. If you know that there's some errors, get on the phone, ring the tax office, speak with them and say, I believe there's some errors in my income tax return or my BAS, whatever it may be, and I'd like to fix them. Can you help me?
So be upfront about it. Be upfront about it. Don't bury your head in the sand. Deal with the problems, and then it sort of reduces the pressure.
Definitely.
Get you out of trouble a bit quicker.
Definitely. I'll give you an example of an unfortunate case. When I was with the tax office, I went to see a guy who owed $5,000 from about 5 years ago. His business had ceased. He stopped work. He basically lost everything and was on Centrelink benefits for that 5 years. But he just racked his brains for that 5 years. What am I going to do? How am I ever going to pay this back? Eventually, he got on the phone, rang the tax office and said, can you get someone to come out here and help me? Now, in that period of time, that $5,000 debt had gone to $10,000 because of two things. The first thing was his initial penalty. The second thing was something called general interest charge.
Yes, the GIC for those. Do a little bit of jargon, but the general interest charge.
And the general interest charge is higher than the normal commercial rate. These days, it tends to vary from quarter to quarter, but roughly you're looking at around 13% most of the time. Now, what that means is this. If you owe the tax office $10,000 and they hit you with a 50% penalty, and they'll go back maybe, let's say they've gone back 2 years, they'll hit you with that general interest charge from 2 years ago. So you're being hit with 13% the first year, compounded with another 13% the year after. And that's how it can double over a 5-year period.